Thank you very much, Sean. Thank you very much, everyone. Welcome to another session of RM Smart Investing lesson. I'm so pleased to have you. Uh, Today, as I've mentioned before, we like to change the subjects, go from technical analysis to commodities, option strategies, and other kinds of strategies, and go back to economics. And with what has been going on, as you know, with everything is very much in the hands of right now the Fed and the central bank. And because of that, with the question of inflation, interest rates, and basically the effects of that on in employment, uh, basically I thought this would be a timely subject if we can review what is Fed stands for, what is central banks, and I'd like to look at their purpose. And if you don't mind, I'd like to go a little, have a journey through the history of the central banks and when they were created, what was their purpose. As you know, I'm a big history buff. I know every new generation thinks everything is different this time. And obviously, of course, we've come such a long way with the technological advancements in the world. You know, in a matter of 1 year, we've gone 100 years of improvement and advancement, but we're still human beings. And as human beings, we still have the same biases, the fears, the joys. And what happens, that's what I believe the history is such a good guidance for the future. So if you indulge me for about the next 30 minutes, hopefully it will be some clarity about where we stand as where we are. So first of all, what is a central bank? Because we hear about that, we think about Fed and Jerome Powell. Now, basically, the central bank was a term was used to describe the authority for policies that affect a country's supply and of money. Basically, it is all about money. It's a centralized place and credit. So what the central bank does, it uses the monetary policy, which we'll discuss it a little later, and they have something called open market operations, which controls the interest rates and the discount window lending and changes in reserve requirements, which is very important. And it's not just, again, we think of it in the United States, they're all over the world, with the large developed countries and developing countries. Each central bank does a similar thing. And you think about China with their reserve requirements and how they can affect the banking system. So, but what they do, by doing that, they affect the short-term interest rates and the monetary base, which is really currency. And we will discuss really the main purposes of the central bank in the future slides. So by doing that, they achieve their important policy goals. So and visually, when we look at the function of central bank, we talked about monetary policy, which is really setting the interest rates, but also having a stable currency. And they issue the money, they ensure the stability of the banking system. And the thing is also, which is very important, has come many times into play, is that they are the lender of the last resort. They are this mother bank that when everything dries out, they're the ones who can bring the liquidity, not only to the commercial banks, but the government in a sense. And the interesting thing is the values and beneficiaries of a real central bank. The central banks are supposed to be independent, and we emphasize that because that's what they are, the ones who want to be away from the other branches of the government. They cannot be really influenced by, let's say, the president of the country, the leader of the country. So that's the most important thing, because they want to look at it from the eyes of their beneficiaries, their benefactors. So the main thing is they're independent, they have transparency, they are supposed to be very professionalism and excellence. So they usually, this is what encompasses a real central bank. So their beneficiaries are the society, their partners, the central bank staff. They work with them in different areas. And of course, the financial sector which the stability in financial sector brings instability to really the society. So the reason I emphasize that independence is because fortunately, especially when we go to emerging and developing countries, you do not see that. All of a sudden, they want to influence what the central banks have to do. And a good example is like last month, President Erdogan from Turkey. He's not supposed to. He can fire the central bank, the head of the president of the bank, and the chairman, and who tells them, hey, listen, increase the rates, decrease the rates. And that's not supposed to be. So that's the main thing for a real central bank. They want to have the independence. And the transparency has become even more because of, again, access to information. It's easier to have immediate access and have the Q&A, for instance, with the head of the central banks, and that's very important. This is, I think, probably for me is the most important slides that we will share. There's a lot of good slides, but this is very important because we talked about the monetary policy and what is the three goals of modern monetary theory, which is really encompasses the Fed and the central banks, is the three. And once we understand this, I think you will have a lot more clarity to when, for instance, our Chairman Powell, the Fed chair, comes and speaks on the FOMC days and other things, you shall see why things are so interconnected. So the first and most important for the responsibility of the Fed and their monetary system is the price stability, or stability in the value of the currency that we have. So today, this means maintaining a sustained low rate of inflation, because with the much higher inflation rate, you will have a very devalued currency. So that's number one. The second goal is a stable real economy. And what that means is they like to have a high employment and high and sustainable economic growth. And that's why this employment numbers, for instance, coming out this Friday, is important under decision making. Another way to put it is they want to have that monetary policy to make sure that it smooths the business cycle. And therefore, we don't have the shocks that we have. They want to offset that. And unfortunately, we've gone to a few of them in our lifetime. Depending on your age, at least I'm sure you remember what happened last year during the pandemic. Some of you are old enough to remember the financial crisis of 2008, 2009, and we go back to 2001, and so on. So that's what their second, again, goal is. The third goal is the financial stability, and what they want to have the efficient, smoothly running payment system, and this way it prevents that the financial crisis is. So they want to make sure that the transfer of the money and the system is fluid. So now let's go into history and find out how the central banks, how did they start? What is the beginning of it? So the first institution, the way we look at it as a central bank, was the Swedish Riksbank, which was established in 1668. And what it was is a joint stock bank. And what they did, they worked together with the government to actually lend the government funds, and they were really declaring to be able to lend those government funds to commerce, to other society, to banks. And if not, a few decades later, in 1694, the biggest really of all the central banks, especially in that era, remember the British Empire, with the vast amount of as far as trades and the power that they have, that's when they really needed, as far as the banking system goes, they're really on that era. There was a famous central bank, which was the Bank of England. And that's when that was established. And basically what they were doing, they were purchasing government debt. Now, after that, there were a few other banks in Europe. They started gradually with the similar purposes. Again, it was a cooperation between the government and the central bank. But then also there was some other purposes came into picture. So after the French Revolution, for instance, when Napoleon Bonaparte came to power in 1800, remember, we had a chaos in that country and we had the unbelievable inflation because of the hyperinflation, because of the paper money. So basically, he established the Banque de France and started creating a currency that it will aid not only the government to finance, but also more of a having a more of a central currency in a sense. Because what was happening, there's a lot of the central banks, what they were just having their own private notes, and that was serving as a currency. So they really had the monopoly on the whole thing. And that's what's meant to be changed. I mentioned about, before going any further about the history, the lender of last resort became, as far as the purposes of the central bank. It came into the picture, especially in the earlier era, and we're talking about when we're talking about Bank of England, for instance, in the times of the financial stress, and there were like a lot of events happening. Remember, the farming was a huge industry in a sense, and at that time, obviously, food industry, the harvesting was important. There were the railroads, the industrial revolution had happened, the roads, the faults with that. Or, of course, we had the wars. So they needed liquidity. They had to scramble all these, the commerces. And what happened was, this is where the central banks would come. And they were the last, or the ones that they would bring the liquidity. And what they would do, they would go through their own banks and convert the deposit into cash. There was a bank run, for instance. It was a crisis like that. So basically, what happened was, because of these panics that happened, that's when the lessons came that they have to bring this liquidity. So, especially a lot of central banks, they would have their own gold reserves. So they will protect their own deposits. And what they would do, they would not share. They would not bring the liquidity. And because of that, what happened, we had major panics in 1825, 1837, 1847, 1857. And because of that, these banks were really criticized because their job was to bring the liquidity. So what happened was, in this situation, especially Bank of England came with something called responsibility doctrine. And because of that, they ended up, rather than thinking about my own private group, my private banking, what is in the best interest of the public? And it became the public interest. So when we look back at Bank of England, believe it or not, since 1866, we hadn't had any crisis for 150 years till what happened in 2007, August 2007. If you remember, or you had Northern Rock, I remember that, there was a bank run in Northern England and then just affected everything. But they kept it pretty much. And again, the 2007, it was truly a global financial crisis. So let's take our journey to United States, and that's what we're very much involved. And of course, being the largest central bank, so the whole world watches this. Although, of course, the European Central Bank, Bank of England, Bank of Canada, Australia, we look at, and of course, Bank of China. So all these are interconnected, and of course, Japanese bank. So we are really watching, but everybody watches the Fed, or this United States Central Bank. So believe it or not, US did have central bank in two different eras. Earlier in 18th century and 19th century. So from 1791 to 1811, they actually came up with the idea of a central bank. And then the second bank was from 1816 to 1836. Now, both of these, they try to model Bank of England. But this is where the difference is. Remember, this is a new country, being independent, and they're coming from a world that they really didn't want a concentration of power in one place. So because of that, there was a lot of suspicion. And what happened, they just didn't trust this situation, so they got away from this centralized bank and they ended up really the free bank, open bank society in a sense started. So between 1836 and the Civil War in America, there was a period known as a free banking era. And it allowed really for everyone to get into banking with no regulations. And we shall see what was the consequences of that. So because of that, a lot of these banks failed because there was no regulations, so they would come and they would default. And during that, a lot of banking panics also occurred. So we will review some of them. Now, so because of that, the payment system was really inefficient, and there was a lot of different state bank notes. So each state had its own bank notes, and there was a lot of counterfeit in circulation. So because again, there was no central figure, they could not really manage this. So that's when, after all these panics, during the Civil War, the government decided, let's create something called national banking system. So we're still not in a central, so-called the way the central bank is, but it is a national banking system to make sure we monitor and regulate those. So here comes 1863, right in the middle of the Civil War, the National Banking Act started. So the National Bank Act of 1863, when it was passed, it allowed to have a nationally chartered banks. So basically they had to go through to be approved to become a chartered bank, that they could actually circulate notes, which was backed by the US government securities. So there was a central government who backed these. So because of that, because each state had its own notes, the government decided, well, we're going to put taxes if you have your own state bank notes. But if you have the central, like a regular dollar, for instance, let's use that, and it's a government dollar, then you don't have to pay taxes. So because of that, they decided, try to have a uniform currency. Of course, this was a tough time. So if you can see, there was a lot of suspicion again. So because of, again, those things, even the taxation, a lot of these state banks continued, and they started just keep growing because they had these demand deposits, which is almost like our CDs we call, and that's what happened again, which is called during that free banking era. So it wasn't a big success. And then, although there was some stability because of the currency, because of this nation, again, we had growing pains, especially after the Civil War, but it brought at least some path to some stability. And it was a good start, but we did have bank runs, which when people just want to get their money out of their bank, and then the financial panics continued happening. We had the 1837, which we'll discuss, and then we had 1873. We had in 1893, for instance, there was a banking panic, which was the worst depression as of that moment in the United States. And they had never seen that, although we had 1837, which was that was the worst depression, with the collapse of banking, collapse of real estate. 1893 was really bad. And this is when the economy needed to be stabilized. And what happened was the financier, JP Morgan, decided that, well, this is time to help, with the help of him, and because he was affluent, and I will review his life story a little bit at the end, without his help, the financial markets would have collapsed. So it was clear that this time, the nation's banking and financial system really needed attention. Remember, this is the time of the Industrial Revolution. We got Gilded era, the flourishing of the United States. So now comes the night after that. It comes in 1907. And these are the reasons I want to review these, because we look at today and we say, well, we have, again, I mentioned to you so many different things. Everything's different than where we were in 1907. At that time, we talked about the railroad and the movement of the goods the ease of movement of the goods. Now everything is commercialized on the internet, digital commerce, we talk. But as I mentioned, these things happen, and the history has a memory, although we as people have a very short memory. So 1907, because of the speculation on Wall Street, it ended in failure. A lot of banking, severe banking panic happened. Again, JP Morgan was the person who came to avert the disaster. So I don't want to get into politics of things. There's a lot of theories about JP Morgan, his intention, I think, but these are the history. These are the facts that he helped, whatever reasons they were. And if you recall, when we think about the greatest traders, for instance, Jesse Livermore was very much involved in this era with his trading. So by this time now, a lot of Americans are stressed out. They want to know, this cannot happen over and over. We just had that 1873. Now we have this 1893. Now we have 1907. So they are asking for a reform on the banking system. And the structural reform had a big division. So we had these, again, the affluent, the powerful, especially mostly from the Northeast and Eastern cities, and there were some progressive. So it's about central versus decentralized banking. And they had to come to a consensus. And that's when the initial things started going again to come up with a solution. So what happened was this 1907 panic really helped to come up with a solution, because they needed to think of something. And really that was the mother of, we call it the Federal Reserve System, the banking. That was happened in 1913, but the cause was this. So basically what happened was, again, they came with the idea we have to have a uniform and elastic currency, and we have to be again, goes back to lender of last resort. How many JP Morgans are there, and how we can rely on the financiers. So, and then the 1914, if you recall, 1914, 1918, the World War I is happening. So Woodrow Wilson comes with the idea we will talk about in the next slide, how he put together to come up with this idea of having the Federal Reserve System. So again, this was the idea was that banks had to really initially, they didn't attach a lot about to maintain domestic economic stability, but then this World War I really changed everything because of the World I, then the involvement of the United States, and then obviously you have partners globally, it's affecting everything. So the Fed began focusing on both external stability, which was important with all what was going on, the gold standards, and of course internal stability. And basically that's, again, was a creation of this. Unfortunately, when we fast forward, the Fed's monetary policy, what they had done, it really led to a lot of mismanagement to the 1920s and 1930s, which you're familiar. We talk about the Great Depression, so we will review that. So let's go back to that's 1913, the birth of the Federal Reserve System. So from December 1912 to almost December of 1913, there was Glass-Willis proposal. And so Glass, he was a representative from Virginia, and Willis he was an economic professor from Washington Lee University, and they came an idea to put something, the idea of the Federal Reserve, and they work again. Woodrow Wilson, President Wilson, reviewed that, and they actually started working from 1908 to 1912, and basically they came with this idea. So finally, December 20, 1913, President Wilson signed this act, the Federal Reserve Act, into the law, and it was a compromise. So what it was, now you have a decentralized central bank. So you had, that again, the public wanted to have something that had the control, and then the private banks also want to have control. So they kind of compromise at that. Now, what they were thinking of before this whole thing started, now you can see the involvement of the Treasury Secretary and the Secretary of Agriculture. Again, we go back 1913, see how agriculture had a lot of strength, a lot of banking was done. We had the Industrial Revolution, industries are growing, and also agriculture played a big role in the United States economy. So what they did, they were part of this group, and then they had a controller of the currency, because that was one of their major purposes, to make sure that the currency is stable. And it was very difficult, by the way. But by November of 1914, what they decided, they said, well, we could not have just one place to have the heartbeat of the economy. So why don't we have 12 cities chosen as sites for regional reserve banks, where they're open and they control, for business, and they can see their regional economies from their own eyes. So now we have then we have collective look at what is happening in the government. One of the things, interesting things, which I will show you, we have our 12 reserve banks. You will notice a lot of them are East Coast or kind of Midwest, and there's only one West. And now hopefully it comes to your attention why it was this. Again, this is 1913. So that's the reason, basically, there was a lot of emphasis from Boston and New York, Atlanta, for instance. So 1929 and 1933. When we think of 1929, we think of the stock market crash, and 1930s, the Great Depression. So during the 1920s, the Virginia representative, which I mentioned, Carter Glass, he was warning about the stock market speculation. And again, I bring you back. I know you look at it to say this, but last year it created with no commissions and the fast internet and everybody's on laptop, being at home, it's such an ease of transaction and other things. But again, you want to be always have an out. So nothing goes forever. And this was really what's happened, the roaring 20s when we go back. So after the World War I, we had the Spanish influenza flu. And after that, it was unbelievable ecstasy in a sense. So there was a large speculation in the stock market. So basically, he was warning that. And of course, as you know, in October 1929, the stock market crashed. And at that time, the nation fell in the worst depression in the history. And we know what happened in 1930 to 1933. 10,000 banks failed. And there was so many bank runs, almost 25% unemployment. And by March 1933, President Roosevelt, he was just newly elected, he actually called a bank holiday, declared bank holiday, which was give a little time to get everything in order. So they were looking for solutions, and they wanted to know what to do. Of course, a lot of people blamed Fed, and we shall see some of the reasons they did that. And they were thinking that that's what Fed is supposed to do. And that's another story. If you're interested, we could have just there's a lot of great articles, but also a great history of depression. What was the causes of that? And again, it's a great lesson. And I know Chairman Bernanke, he was a big student of that. And when he was in charge in 2008 crisis, he used a lot of those lessons from that. But anyway, so that's what a lot of people thought, that they shouldn't, there was an inadequate understanding of monetary income. And they felt that the Fed could have done much better management what was happening, and we shall see actually next slide. And that really actually worsened the depression. Again, that's a different story. We want to review that. So I just wanted to give you this. There was something called Real Bill's Doctrine. And what the Real Bill's Doctrine was saying, that they argued that the quantity of money needed in the economy would naturally be supplied as long as the reserve banks lent funds only when the banks are presented eligible by, there was some commercial papers, that's when they started, so for collateral. So one of the consequences or after facts is that these real bills doctrine was that the Fed should not permit banks lending to finance the stock market, which was a lot happening in those days, of speculation. So, and what happened was they came with really tight monetary policy, which when you have the tight, you basically taking the carpet out of liquidity, under the liquidity, and that's what it was, a tight policy. And consequently, because of the tight money, the Wall Street, the goal was to stop that Wall Street from the speculation. But unfortunately, what happened was it started the recession in August 1929, and of course, the crash of 1929, and in October. So because of all these, then again, because the Fed really failed to act as a lender of last resort. And that's why I want to have that clarity of what is this lender of last resort. So that obviously when there isn't, the money supply collapses and there's not money, so then you have deflation, and that's when the depression starts. So in many ways, there was a lot of errors can go around, and they thought, by low short-term nominal rates, because there was short-term, so that's the sign of monetary ease. And that's what they thought that, obviously the banks don't need our money because it's at low rates. So that's where the mistake was. Again, this was more of a connection of, I think the Great Depression has its own class. So I just want to tell the role of the monetary policy in affecting the Great Depression. So after the Great Depression, what happened was when it started, the Federal Reserve System was the whole thing reorganized, and then we had the Banking Acts of 1933 and 1935. And what they did, they shifted, and this is important, the power from the reserve banks to the Board of Governors, and the Fed was more subservient to the Treasury. So here the Treasury was overlooking. So they're talking about independence and all that. So you can see that's what happened until 1951. And what happens again, the Fed came back and became independent again, and began following a really counter-cyclical policy under directorship of Chairman Martin. And what happened was the 1950s became pretty successful. Of course, there were a few other reasons, I would say. It's the end of the World War II. Really, the generations are coming back in a sense and being born at that time. There was a family unity is happening. And this was a new generation coming, which we call them baby boomers, for instance. And that's what the 1950s became successful. So was obviously we talked about Bretton Woods, which was with the gold as becoming the standard, and the gold standard and the dollar relationship. So what Bretton Woods said, United States could follow a $35 per ounce gold standard, and all the other currencies will peg to dollar. So basically, with the gold standard, but the dollar became the currency of reserve in a sense. So that was important. So it brought really the stability and kept supposed to help to keep the inflation low. Now, we go to 1960s, all of a sudden, the Fed, and this is important again to understand, they became more activist. And that's what sometimes there's this fear that when you hear central banks becoming more active and they're taking activist roles rather than being the controlling role, that's what happened in 1960s. And they became in their stabilization policy. So what they were really thinking is the priority was obviously in 50s, it was low inflation. What they thought, well, let's have a high employment. And because of that, they really Keynesian philosophy of the 1930s, John Maynard Keynes, and its ideas they thought with the Phillips curve, which is, it was a trade-off, the Phillips curve was saying with inflation and the jobs. employment, inflation will bring the employment. So there's a curve, not knowing that it's only a short term. And at that time, they believed that in a long term, it has been disputed that it doesn't work. So they were thinking that, well, with inflation and employment, unemployment will go down. There's this curve. So basically, they became more activists in that sense. So what happens? 1970s comes, and the consequences, all of a sudden, we have a buildup of inflationary pressure because of, again, the idea was with that, if we have higher wages, we will have higher employment. So people will work and they want to work more, and that becomes actually inflationary. So that's what the consequence was, and we know about 1970s and the inflation. So 1970s high inflation comes, end of 1979. I vividly remember what's called misery days, misery index we had, high interest rates and high inflation. So Paul Volcker, which was the chair of the Fed, he came with something called shock therapy, 1979, 1982. He just decided to tighten the monetary. That means less money available. And if there's less money, then the higher interest, right? So there's a difference. When there's tons of money, obviously that means it's really the flood of money, the lower interest rates, or the opposite. If the interest rates are low, there's more money going around. Here, he tightened the interest rates, basically kind of collapsed in the same, tightening the economy in a sense, because he wanted to slow down the inflation. And interest rates, I know in the 1980s, paying 15, 16% for the mortgage interests. And that's, I remember the properties paying 15, 16%. So believe it or not, initially, and we think about 1982, 1983, initially the shock led to a really sharp recession and a very high unemployment. But it was successful in breaking back of the high inflation expectation, and it has a lasting effect. And the following decades, basically, this continued, and that's why we had inflation continuously declining. Of course, there was the tax laws changed, the idea of real estate, and then we had the stock market, favorable capital gains, the money started moving from basically cash account, money market, CD account to favorable taxable investments such as stock market. So gradually the inflation actually declined. And after that, and I followed, the policy of implicit inflation targeting in the 1990s. That's what they're trying to do. And that's why the Fed funds became the policy instrument. So these, some of these things go back to the principle of the golden standards. So, and that's what they felt. That's what the Fed's commitment to low inflation, the credibility of that. So 1990s comes, and this comes after, Alan Greenspan came after Paul Volcker, and then we had that famous Monday when October 19th, the markets dropped. The Dow Jones was down. I remember that day vividly. It was down 522 points, or 520 points, 22.3% or something like that. And I remember that day vividly. I was talking to the trading desks in actually Twin Towers, and talking to the desk, and I could hear the panic. So what happened after that stock market crash? What Greenspan brought to the market was the assurance. Basically, it said that in one sentence. It said in October 20th, the Federal Reserve, consistent with its responsibility as a nation's central bank, affirmed today its readiness to serve as a source of liquidity. And I emphasize this, the source of liquidity to support economic and financial system. So it was really Greenspan started that. And after that, every time we've had a panic, that's what the Fed has become, the source of liquidity, to make sure that what the mistakes might have happened in the 1928, 29, when there was tightness and stuff loosening, it will never happen. Of course, that has its own consequences, but this is not time place to discuss those. But anyway, so the 10-year economic expansion of the 1990s really, it was unbelievable. We had the technological advancements, obviously the tax laws, the defense. There was no Soviet Union, for instance, so the defense budget went to other places. So basically, that was a great economic expansion until we had, again, the collapse in 2001 with the internet market bubble, and then we had a short and shallow recession in November 2001. So basically, what was happening, again, the Fed started lowering the interest rates. Now, what they had done, one of the reasons this happened, again, it goes back to Fed again, there was something, if you recall, we had the Y2K. The whole thing is moving from 1999 to 2000. For years, all the businesses, the government, everybody was in panic because they had to change the system. So what the Fed was doing at that time, they were really pumping the money to make sure they would avoid the crisis of any type of shortfall. And again, learning lessons from the past. And so artificially, the Fed really lowered interest rates, some say too low. And we shall see the consequence of in the next slide. So, and basically, that's what they were hoping, that they will not be. There was a lot of fear. I don't know if you remember that, with the Y2K, the banks, the governments, everything is going to stop. And so I know a lot of my friends who were engineers, they made very, very good money. They were all working on that 2K problem. So anyway, so basically, but the 1990s was really generally known for declining inflation and really peacetime. As I mentioned, it was a peacetime dividends at that time. On top of that, then we have 9/11 happens, and then 9/11 again. The Fed came to rescue. They mentioned again they will provide the liquidity, they will loan, so there wouldn't be any panic or crisis, as any type of panic or crisis in the banking. And basically, by end of September, Fed lending had returned to pre-September 11 levels, and potential liquidity crunch had been averted. So again, you can see the role of the Fed in all different types of crises. So now, this was important change in the attitude toward the Fed. We fast forward to 2000s, and what happened, because of these lower interest rates, what has happened, the low mortgage rates, now we have available credits, which has made the homeownership possible. And again, the housing prices kept going up because of the demand. And of course, you know, the rest is history in a sense. Because of all these mortgages, and you ended up with so much money that it then become of a subprime mortgage, that people who were not credit worthy, they were receiving, you know, application, or the applications were approved. There was no, basically some of the places, no down payment. So that came to the securitization of these risky mortgages. And consequently, as you know, all of a sudden with all that, now the poor credits start showing, and a lot of mortgages are actually higher than the value of the houses. So the housing prices faltered in early 2006, and gradually then we had the slice, and the defaults are happening, and the homeowners cannot afford it. And then the subprime started with the subprime, and remember the Fannie Mae and Freddie Mac crisis, and it continued, and then homeowners could not make their payments, and the banking crisis happened. So here comes in 2008 with that, what had happened with that, it's a little too late, at tight credit, because of now the banks are thinking, well, we cannot allow this happen. So people are very worried. They're not buying high ticket items. So now the slowdown in economy, and it just carried all over, and it went globally because of all the things are happening. You know, we are so interconnected. So when there's no demand, there's no imports, these businesses are canceled, expansion, no capital expenditures, and all that. And that's when the 2007 was really the top. Everything was shrinking, and the recession really while it was mild until the fall of 2008, to really continue. So one of the things was, when we think back, is Bear Stearns, for instance, that the failure of Bear Stearns investment banking, that was a big thing in 2008, and that was going to have a domino effect. And I would go even farther. I would look at again, these are looking at the causes, the money markets, the stability in them. And of course, the credit defaults and the securitization of all that. And basically the Fed Reserve, what they did, they end up giving non-recourse loans to JP Morgan Chase to facilitate the purchase of these certain Bear Stearns assets. So again, after that, now we're having these domino effects. And Fed Reserve decided to secure the loans of the American International Group, the AIG, and that was a large insurance company, and to make sure they keep them fluid. So here we are, open market committee. This is again, Fed comes in and they're really facing a big crisis, and it's December 2008, and they bring their Fed funds rate to the lowest in 50 years, and basically want to bring the liquidity. So then it comes the Lehman Brothers, and the Lehman Brothers basically, now that was the dagger, really, what really made everything showing that, this time we are not going to survive that. So that's why the government let it go. And then we can see how the markets, now the Fed started pushing $300 billion in long-term treasury securities, and then they ended up authorizing $1.25 trillion in mortgage-backed security, which I will discuss a little more in the future. But I'm just saying the role of the Fed buying the Freddie Mac and Fannie Mae's agencies, mortgage-backed securities by them, to just keep the fluidity and to make sure there's not more foreclosures. And we had short sales. So that was important, because after that, most of you are familiar with it, but I will review more. So I'm going to go back to summarize what we've done in interest of time. The Fed, basically what it is, the Fed Reserve System is a central bank and monetary authority of the United States. And they provide the country with a safe, flexible, and stable monetary and financial system. So what they do, I mentioned to you, they have 12 regional Federal Reserve banks, and the main duties include conducting the national monetary policy, as I mentioned, supervising and regulating banks, maintaining financial stability, and providing banking services. And the FOMC, the Federal Open Market Committee, is the Fed's monetary policy making body and manages the country money supply. And we've talked about, again, you see it 8 times a year. It happens. You see the markets are paying attention. So what happens last year, now again, the Fed comes in the picture. In March of 2020, Fed officials, they said they would buy $200 billion of agency mortgage-backed securities and $500 billion of treasuries, because this was something that, again, this was a health crisis. Everything stopped. So they were just pumping the money, make sure there's no defaults, as little as possible. And initially that was described as a way of helping maintain market liquidity. But by December 2020, officials said that they would purchase $80 billion a month in the treasury. Remember, their job is to do the lower, or the Fed rate, which is it's a very short-term rates. It's interbanking rates. But when they come and buy the treasuries, now they're trying to bring the liquidity to the long end of the market. So they decided to do 80 billion a month in treasuries and 40 billion a month in mortgage securities. And that they continued. So between early March 2020 and late August 2021, the Fed has raised the value of assets. So they have a balance sheet. So basically their book, it has gone from 4.2 trillion to 8.3 trillion. So basically it's which is about $4.1 trillion is in their books. So as long as interest rates are low, that's another reason for the fear of a higher interest rate. So usually we've talked about the recessions that happen. So what the Fed does, they push the interest rate down to create activities, and they do it for the banks with the overnight loans. So that's why we have Fed rates, for instance, we cut 0 to 0.25. And then this allows the banks to offer loans to their businesses so the business can continue. Unfortunately, last year, as you know, there was no business. Doesn't matter how much money comes in, there was no activities. But that was the goal. If the recession happens. But in the 2008 financial crisis, they understood that just going to zero, it uses its utility. It can go that far and stop. So that's why they started buying bonds. And that's where it started. And that's why they would go in open market and start buying these long-term bonds. And by doing that, they would lower the long-term rates which was usually outside their forces, right? But because of the supply and demand, they could keep the rates down, which is happening now. And that was called quantitative easing. And then we had the quantitative easing 2 and the 3. And basically what Fed was doing last year, they started in March, that was the continuation of really quantitative easing. So you hear about this taper, and what is the taper? We talked about this easing, purchasing these mortgage-backed securities and treasuries we talked about every month. So what the tapering means is in describing the plan that they're going to take the foot off the gas gradually. So instead of, let's say they were buying 80 billion, and what Bernanke did, for instance, he just said we're going to go gradually down 10 billion every month. So that's what the tapering means, gradually reducing the purchase of these bonds. Now, we mentioned tap and be talking about now, but again, that's what Chairman Bernanke did it. They've done it in central banks of Japan, in European Central Bank, Bank of England. They all have done the same thing, and they continue. Now, when we talk about now they're worried the markets have this volatility, what is taper tantrum? Taper tantrum started in 2013, that the markets got really panicky because they said, oh, Bernanke announced that he's going to start gradually taking his pedal off the gas, and that's what the market reacted, just these nice words come taper tantrum. In the meantime, now the other central banks are following footsteps of the lessons from the back. So Christian Lagarde said that ECB has been purchasing the debt an average of 80 billion euros a month, and they have about half a trillion left to spend. So out of the 1.85 trillion, so they are doing the same thing in September. They are going to slow the pace gradually, but they are very wary of what is happening. So they're hoping by end of this quarter, or this coming fourth quarter, it will be, gradually would do that. But again, it says that it's not tapering, and she's very aware of the past. So the next 2 or 3 slides, few minutes, I just want to share with you the 12 bank locations. We talked about the 12 regions. Again, you can see Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City. Then you only have Dallas in the south, and San Francisco. Hopefully with my explanation, now you know why. Briefly, just about these panics, 1837, remember the banking system that 1836 started. You have these open banks around, and you can see that what this happened was explosive in the land prices. In New York, real estate was going up to the roof. So they actually, in 1837, the banks in New York ran out of gold and silver. So basically, you can read this and on your own. There's a lot of commonality when the panics happen. So that's why the history is a good lesson. Now, this happened after 1836, which was things were really going up. The price of land, cotton, and slaves at that time rose sharply in those times. And that boom's origin had many sources, both domestic and international. Again, just look back and then bring it to our lifetime. So, and there were a lot of things that actually caused basically this, all of a sudden, the collapse in the cotton prices, the collapse in land because of the lending, the banking crisis. So that was a panic of 1837. A little tidbit about JP Morgan, so you can read it. I'm not going to take your time, but I just want to tell you where he came from and who it was. And it was during the Gilded Age, and Gilded Age was the late 19th century. And looking at again, the era of rapid economic growth, we're looking at the railroads, we're looking at the wages are growing, people are really looking to the optimistic future. And that's when the Europeans decided to come. The migration started happening. Millions of Europeans came. So that's why it's what's called Gilded Age. All right, thank you very much. I know it's supposed to be 30 minutes, but I just had quite a few slides, so I want to go. Hopefully you feel a little more comfortable about understanding the Fed, the central banks, a little history. Yes, history is a good lesson, in my opinion, and we always have to be aware of our past to make sure we have a bright future. Thank you. With that in mind, I appreciate your time, attention, and we can stop the recording and open up for the questions.